Meet Ashish Kacholia, known as the big whale of the Indian stock market. No, not because he swims in the ocean or eats marine animals for breakfast, but because when this man moves in the market, ripples turn into tsunamis. His stock picks can make small caps look like they are on steroids. He's not your typical fund manager. He doesn't manage other people's money. He manages conviction, a soft-spoken IIT Bombay alumnus who once walked the halls of Prime Securities in Edelweiss, learning the ropes under the watchful eyes of Dalal Street veterans. Back in the day, he co-founded Hungama Digital, yes, that same entertainment platform, alongside none other than Rakesh Jhunjhunwala, India's own Warren Buffett, and the original Big Bull. Ashish is a master of identifying small and mid-cap companies destined to become giants. Ashish Kacholia doesn't chase Tata, Reliance, or Infosys. He hunts for companies that dominate a microsegment, something like pharma packaging, clean room equipment, or precision auto parts. Holds a dominant market share, often a monopoly or duopoly. Faces limited local or global competition. Has high switching costs and entry barriers, like regulatory approvals, tech know-how, or long-standing relationships, which means customers cannot switch easily to competitors' products. Don't be afraid of lesser-known names. Dig into companies that solve complex problems for specific clients. Look for dominance in a subsector, not overall market share. Kacholia looks for stocks which are under-owned by mutual funds and institutional investors, lack media or brokerage coverage, but still having rock-solid fundamentals. These companies, often in traditional manufacturing or B2B niches, are invisible to the hype-driven investing crowd. But to Kacholia, they represent unmined gold. If the company is not in fintech, AI, or renewable sector, then it's probably getting ignored by investors. Kacholia is known for doing channel checks and ground research by visiting factory premises, talking to distributors, speaking to former employees, talking to customers and competitors. Because the truth about a business can't be seen from a balance sheet alone. This boots-on-the-ground approach gives him a major edge over those who rely solely on doing financial analysis of companies. Imagine this. You're eating at a roadside dhaba that serves the best butter chicken you've ever had. So naturally, you ask the owner, "Why don't you open more outlets?" He smiles, wipes his hands on his apron, and says, "Are bhai saab, ek kaam sambhalta nahi, dusre ki sochum." That's exactly what Ashish Kacholia avoids in business, because in his world, scalability isn't just a fancy MBA word. It's the difference between a good investment and a multi-bagger. A scalable business is one that can grow revenue exponentially without a matching increase in costs. As these businesses grow, their profit margins expand too. Think of a local tuition teacher versus an online learning platform. The tuition teacher teaches 20 students a day. To teach 200, he needs 10 more teachers. But an online platform like Byju's can teach 20,000 students using the same video content and app infrastructure. That's scalability. To find scalable company, a retail investor should look for the following points. High gross margins. If the company keeps a big chunk of revenue as profit, that's a green flag. Low incremental capital needs.
एसेट लाइट, इसका अर्थ होता है जब बिजनेस अपनी बुक्स पर कोई एसेट्स नहीं खरीदता, और इसका रिवर्स होता है एसेट हेवी, जहां बिजनेस चलाने के लिए अपनी बुक्स पे ही सारे एसेट्स खरीदता है। जैसे कि उबर एक एसेट लाइट कंपनी है जहां पर वो कोई गाड़ी ओन नहीं करता। दूसरी तरफ है मेरू कैब्स, जहां पर सारी फ्लीट मेरू खुद ओन करता है बिजनेस चलाने।
Check whether the company can grow sales without increasing debt in the balance sheet. Kacholia blends value investing with growth orientation, picking companies trading at reasonable valuations that also show strong revenue and EPS growth. It was 2016. The market was buzzing. Everyone was obsessed with e-commerce, IT, and FMCG. Kacholia, however, took a walk into the chemical sector. Chemicals? Buy to Tikena? That was the reaction from most people. But Kacholia saw something different. Boom! Value? Affirmative. Growth. Affirmative. Market attention. Negative, but that's good. Kacholia enters quietly, holds them patiently, and when the world finally caught on, the stocks were already 3x, 5x, even 10x. Here's what a retail investor should look at if he wants to combine both value and growth style of investing like Kacholia. Revenue 5 years CAGR. Consistency matters more than sudden spikes. Operating margin trend. Is the business getting more efficient over time? Return on capital employed, ROCE, last 5 years average should be more than 15. Debt to equity, lower than 1 is reasonable. Free cash flow. Is the business throwing cash or burning it like a failed startup? In the world of investing, skin in the game means that the promoter or the founder owner of the company holds a large chunk of its shares. Let's break it down. If a promoter holds, say, 60 to 70% of the company's shares, any rise or fall in stock price directly impacts their own wealth. They win when the company wins. They bleed when the company suffers. The golden word here is alignment. When the shareholders and the promoters are perfectly aligned, magic happens. You don't need to micromanage your investment because the promoter is more worried about the stock falling than you are.